We are off to the races here at the New York Stock Exchange. Stocks officially open for trade in the final trading session of the first full week of 2026. Joining me now with more is Todd Sohn, ETF and technical strategist at Strategis Asset Management. Todd, thank you so much for joining this morning from New York. How does the market look to you as we kick off 2026?
Hey, Kristen, great to see you as well. I think the market looks in pretty firm hands. This is a broad-based move. You have the equal weight S&P 500 back to new highs, and this is seemingly coming at the expense of your cap weight benchmarks, right? Tech has paused here, but the good news is you're seeing other corners of the U.S. market and really the global market too maintain their position, right? So this is not about deterioration of internals or anything like that. This is about other ignored corners participating. That's very good, especially if you're a tactical or active player in the markets.
What does the jobs report this morning for December mean in terms of the trends, Todd? Does it change them at all? 50,000 jobs added in December, below economists' expectations, but the unemployment rate did tick down to 4.4%.
Yeah, I think it's more of the same. Without having a full focus on that area, it seems like the market is reacting in the first few minutes here with the trajectory that's been going on over the last couple of weeks to months, right? Where it's this movement away from large cap growth and AI to some extent because the expectations are too high, and towards all these other areas like financials, industrials, materials, that frankly have been ignored and have not necessarily outperformed over the last couple of years. So I think this is folks just saying, hey, we're taking this data in stride. We're okay with that. And in the meantime, let's go and balance out our portfolios away from things that we might have over concentration to.
It's interesting because what seemed to be working in 2025, also at least at the start of 2026 was, right? And we've seen a broadening out from AI to the technology space in general. What are you watching when it comes to some sector rotation?
I think if you look at sector ETF flows, right, they have been all in on tech, really, frankly, for the last couple of years. And that's been the right call, especially with the proliferation of AI. But then if you look at other corners such as healthcare, energy, materials to some extent, those have seen a massive amount of outflows. And I think that's a lot of opportunity for investors who may have looked past those sectors to get involved there. They're still very much timely buyer work, and they don't seem too consensus just yet based on what the flows are saying. So I think the investors are starting to realize, hey, there's other things out there besides large cap tech that we can allocate to in our portfolios, especially if you want to water down that exposure, right? We know about 10 stocks being 40% of the indices. There's so much other opportunity out there for investors, especially for ETFs or just playing it actively. Those are the areas I would focus on this year, at least in the first half of 2026.
What are going to be the major moments throughout this year, Todd, that you'll be watching that could impact the direction of the overall market?
Keep an eye on rates, long rates, right? The 10-year yield, 30-year yield, right? I think if there's anything that's going to upset the market, the equity markets, and cause some indigestion, I believe it would be a run higher in U.S. rates. Thus far, the 10-year has frankly been range bound for ages. It feels like just this big trading range, not much signal there. But whenever you start to get rates get some momentum, that typically causes indigestion for markets. So that is the one glaring item that I would keep an eye on. I'm curious to see what commodities do from here, right? Metals aside, which I'm not sure I would chase right here, can oil dig in and maybe start to rally? That'll have some implications for stuff like energy. Putting it all together, it comes back to rates. That's when you really get markets upset, when they get a surprise on the upside from rates, and it's not this kind of slow grind trading range that they've been in.
How important is the month of January in stocks performance to kick off 2026 to set up the rest of the year? We hear of so many seasonals in January, Todd. You know what I'm talking about.
Oh yeah, there's the January barometer, right? You got the Santa Claus rally the first 5 days, and then as so goes January, so goes the market, and the analogy is baseball, right? If you are in the early part of a game and you're putting runs up on the scoreboard, you have a much higher likelihood of actually winning that game. So if we can get January off to a good start, the rest of the year, historically, is pretty good So you just want to start to get off on the right foot. It may sound wacky and odd because there's still 11 months left in the year, but the statistics say you get off on the right foot, you're usually in pretty good. Now, the wild card this year is there's a midterm election, and that can cause some volatility. That can cause some drawdowns. So I would just keep that in the back of our minds in terms of planning on how what your allocations are going to be. It can't hurt to have some sort of hedge on, whether it's a put option or some of the ETFs out there that can protect on the downside. Back to your main question, so it goes January, so goes the market.
Todd Sohn, ETF and technical strategist at Strategas Asset Management. Todd, thanks again and Happy New Year.
You too.